Thanks everyone for listening. So, as you guys know, institutional participation is accelerating across the digital landscape. I think recently a lot of regulated financial institutions, market makers, banks, funds, governments, whatever, they are, really exploring what we can do with digital asset treasuries, your blockchain-based financial institutions, institutional grade kind of like custody and related infrastructure. So I guess, the buzzwords recently are all about tokenization, RWAs, institutional adoption. So, I think we have a panel here of very well-rounded speakers to give us insights across these various aspects of things. So I guess before we start the session, I would like to have our guests introduce themselves as well as a brief introduction of what their company is focused on. Please, Fandy.
Yeah. Hi, everyone. Thanks for having me here, and it's good to see everyone. Hope everyone had a good morning. So I'm Fandy. I'm from Kopital Ventures. We're an early stage. Actually, we're a Web2 venture capital that is currently now exploring investing into Web3 companies, especially in the past year. Since in the past year there has been sort of Web2 and Web3 have sort of diverged with all the stablecoin companies coming up. And obviously in the US, there's a lot of the digital asset treasuries that has been pretty successful. So yeah, looking forward to sharing more today and hopefully get to learn more from my other well-esteemed panelists.
Hi everyone, my name is Minesh. I'm a trader at System9 where we develop algorithmic market making software. And more specifically, I guess we are very, very, very interested in developing institutional grade trading infrastructure. I also want to say it's an absolute pleasure to see a lot of familiar faces. I thank everyone for coming and I hope you enjoy this panel.
Hello everyone, I'm Kanet from Quarix. Quarix is an institutional grade blockchain infrastructure created by a part of Custodian Bank. So at Custodian Bank, we are trying to create like a comprehensive digital asset infrastructure ranging from exchange, custody, digital asset fund, and also blockchain infrastructure as well. Yeah, super excited to be here to explore this together.
Hi everyone, my name is Ramzee. I'm from BitGo. For those who don't know us, BitGo is one of the leading digital asset service provider. We're handling 20% of Bitcoin volume on chain, and we're one of the trusted custodian in the market who handles more than 100 billions AUC of more than 1,500 institutions, clients of us. So we'd love to share more and have a very exciting discussion today with those people, experienced folks from all over the space.
Okay, and last but not least, me, Jordan. I'm from D3 Labs. So we are a regulated tokenization platform that's currently in the OJK sandbox, working on tokenizing various real-world assets. Yeah. So I guess let's dive in. I think everyone's curious about what's driving momentum when it comes to institutional adoption. So I guess I'd like to ask Fandy, from a VC's perspective, what are you observing among the institutional investors when it comes to stuff like digital asset treasuries or just assets in general? What are the allocation strategies for long-term treasury adoption?
Yeah, I guess in the last decade we have seen the sector evolve. I think at the start we have seen a lot of token speculation, and even today there are still some token speculation. But I think in recent years, especially in recent years with the US, especially taking digital assets more seriously with the Genius Act and Clarity Act, I think it has spread across different regions. So for example, for us even, we have invested in Web2/Web3 company, I would say, that is focused more on infrastructure. Companies like that are in the market currently, like DurianPay, Cust, and also Red.Pay, who achieved unicorn status recently. And yeah, we look forward to investing in more of these companies. And also, I think we know that the problem with Southeast Asia VC is that VC has been an illiquid asset class. I think digital asset treasury solved that. So by investing into digital asset treasuries as a private company before going public, I think yesterday we see in the New York Stock Exchange 21 with Tether, SoftBank, and Jack Mallers going public. I think that is the kind of things that we can replicate in our region as well.
Thank you for the answer. So I guess we are also seeing like a split in terms of how projects are handling this shift, right? Some of them are going to be more going the route of complying with the regulations, where some are a bit more, they still embrace the idea of decentralization and maybe not focusing so much on, the regulatory compliantness of things. So how would you evaluate like risk, compliance, and the infrastructure readiness before you deploy capital into assets?
I guess digital asset is still a very nascent industry as a whole, right? So I don't think, I guess even the US that's currently, well, the US we're not leading, but I think they are going to lead the space. Even the US are still coming up with the Genius Act, Clarity Act, and the Market Structure Act is coming up. For Southeast Asia, I guess it depends on geography. See which countries are more, which leaders in the whichever countries that the particular company is operating it, if they are very friendly, if they're approaching it with an open-mindedness. I think that's the most important thing. Obviously, like I think you will know this. So one of my first exposure into the space is by investing as an angel in D3 Labs. You guys have been the pioneer in tokenization in Indonesia. And the regulations are still unclear, but with companies like you guys, hopefully we'll have a more clear regulation, and eventually that will give us the confidence to deploy more capital into the space, because I think that in the future, Web2 and Web3 VCs will converge.
Right, so which verticals do you think are attracting the most institutional curiosity today?
For sure, tokenization, like again, you guys in D3, and of course in financial infrastructure, like for example, like Cust. I think Cust raised a pretty big round during the year. And my personal favorite is digital asset treasury, just because I think it's the best asset in the world and it beats all currencies and is I think any company with the most BTC, for example, will probably have the strongest balance sheet in many years to come.
Right, so speaking of digital asset treasuries, I think we're also curious to know how has institutional trading demand evolved? And specifically to Minesh, what role do market makers play when it comes to providing liquidity rails for this kind of DATs?
Yeah, I would definitely say there's been an increasing demand in institutional activity, primarily due to the fact digital assets offer a lot of real-world use cases. For example, treasuries or on-chain infrastructure, which is where market makers come and play an important role. So you talk about liquidity rails, for example. Market makers are the ones who can help facilitate entering and exiting the market in large positions smoothly, being able to hedge positions on your book, or really just being able to manage volatility without moving the market.
I see. So what would you say an institutional grade trading infrastructure looks like, especially for high volume or very automated digital asset strategies?
Yeah, to be honest, there's a lot of factors that go into building institutional grade trading infrastructure. I guess if I had to shortlist a few of the items, automation definitely comes to mind. You want to definitely have automated systems. Next would be stable connectivity. If you go somewhere like CoinGecko or CoinMarketCap, you're going to see that there's hundreds of different venues to trade. CEXs, DEXs, OTC vendors, custodians, etc. And all of these venues have their own API documentation. So building stable connectivity is also very, very important. I would say top of my list would be having very, very strong risk controls. I think it's quite obvious because, look, we're in a very nascent market. Things happen every day. And maybe I'd like to take us back to a more recent example of October the 11th, right, when we had the liquidation cascade. I think this was a unique event because no matter who you were in the market, you most likely got hit. Retail, speculators, market makers, institutions, you name it. And I think the ones who got hit the least are the ones who had the strictest risk controls and parameters in place, things like safety switches and so on and so forth. And I guess lastly would be being able to operate over many, many different venues, such as OTC desks, centralized exchanges, DEXs, etc.
Yeah, I guess it's good when you have cooperation across these different venues, but I guess also it creates a new challenge, right? When your liquidity is fragmented across, I guess, all these different venues, your on-chain venues, different exchanges and custodians. Could you share a bit more, on some of these challenges that you guys face?
Yeah, I would definitely say the biggest challenge in building these types of infrastructure is this idea of fragmentation. You have so much liquidity that's scattered across so many different venues. And all of these venues have their own risk and settlement processes, which can make it quite difficult to operate. So I think the market is definitely moving towards a direction that unifies this experience, that allows institutions to reliably and safely use single source of liquidity to execute. Maybe I'd like to give an example. If you're an institution and you wanted to buy 1,000 Bitcoins, in an ideal world, you would call a market maker or an OTC desk and you'd say, hello, sir, I would like to buy 1,000 of your finest Bitcoins, right? And at the other end of the call, they're going to give you a quote and say, sure, please send us 100 million US dollars and we'll settle the trade. If this facility didn't exist, these same institutions would have to go out into the market themselves and would have to deal with things such as execution risk. For example, slippage, spreads, fees. On top of that, you have to deal with KYCing across all of these different venues. And KYCing in itself can take weeks, if not months. And then also, more importantly, you're subjecting yourself to counterparty risk, right? I'm sure everyone is familiar with counterparty risk, and there is no way you're going to execute a $100 million trade without moving the market on a single venue, right? So you're going to have to disperse that liquidity across many, many different venues, and each of those venues introduce its own level of counterparty risk. So fragmentation is definitely one of the key challenges, I would say.
Okay, I understand. So I guess the infrastructure is really important in terms of trying to unify the experience across different venues. And I guess I also like to have a question for Kanet from Quarix. Especially when it comes to banks and large financial institutions, what is your approach towards digital asset infrastructure?
So I would like to start by saying that there used to be a belief that banks want crypto to fail, right? But what happened in the past few years, I think, have given banks such a pivotal moment that they can no longer just wait on the sideline, and they can't afford to ignore this opportunity. So I can give the perspective from the Thailand landscape. So what banks are doing, they are doing like both sides at the same time. On the one hand, they do the exposure. On the other hand, they do the utilization. On the exposure side, they're trying to get their hand on the crypto and on the blockchain development. It can either be by they have the VC firm that fund the crypto native project. They have the VC firm that fund one of the widest DeFi protocol idea. And also the bank in Thailand, they do some acquisition of the crypto exchange as well. I think that's the one play. And on the other hand, on the utilization side, they have a separate distinct department that try to answer the question like how can we use blockchain to improve the existing operation as well. So yeah, they're trying to do these two things at the same time.
I see. So in your opinion, what do you think the role of an institutional grade blockchain infrastructure should be playing?
So before jumping into the role of institution grade blockchain, I would like to get us to define the meaning of what's supposed to be the foundation of institution grade blockchain first, right? Because there seem to be like a contradiction between what blockchain trying to achieve, the decentralization and the permissionlessness, the transparency, and what bank need to operate, the law of physics that bank need to stand on, which is being able to verify all the user, right? And if we were to put it into landscape, on the completely open blockchain side, we have Ethereum, where there's like complete decentralization, right? But on the other side, we could have like a private blockchain where we have like just a single entity to have absolute control. I think the institution grade blockchain that we want to define, that we want to achieve is something that could be the right balance between these two. I think in order to achieve this, it requires like at least 3 foundations. So the first one is the selective transparency. The second one is the programmable compliance. And the third one is the interoperability. For the first one, the selective transparency, if the real business, imagine you are SME or the large business, you were to use blockchain, you probably not want like your competitor to know, right, what's your current balance sheet and where did you get this and those ingredients, right? This is exactly why the financial infrastructure for the real world, it should have like a selective transparency. It should give the right information to the right people, while at the same time giving the regulator the ability to supervise and to review what's going on in the blockchain as well. For the second one, the programmable compliance, in the financial world, we don't operate in a way that, okay, let's do the beta production live, right? And then let's see things breaks and then fix it. In the financial world, we want things to be like absolute safety, right? So the level of compliance that must be baked into the blockchain is must bake into like the native layer. So compliance for the institution grade blockchain should be something that make the risk to not be like happen first and then fix it later, but should not be impossible in the first place. And the third one is the interoperability. So yeah, of course, if we have the blockchain which no one use, we have no network effect, it will be useless, right? So the right blockchain should be able to connect both the traditional finance and also the decentralized public blockchain as well. Yeah, I think that is kind of the key ingredient of the blockchain. And in terms of how we would utilize it, if we get the foundation right, what we enable is the 3 things. We would enable the real money, the real asset, and the real identity. So these 3 are like a primary color of all the digital asset use case. One, we have this, the possibility for creating use cases on blockchain are limitless.
Yeah, I see. So I guess you as well being part of as a institution under Custodian Bank, perhaps I'd like to also hear from your point of view, what early adoption signals are you seeing from enterprises and various financial institutions?
So in Thailand, all the top banks will have their own blockchain department. We not do just investment, we do something like the hardcore digital asset infrastructure development as well. And also, among the top 3 to 5 business corporate in Thailand, they will have their own blockchain department as well. So for example, if you hold a USDC or USDT and you go to Thailand, if you want to use USDT, USDC with the local, to buy local product or services, there's not only one, but at least 3 to 5 solutions that you can choose on your own. So which one are you going to use? So yeah, that could be like a very good signal of a strong adoption, both from the bank side and the institution side. And one of the other countries that I would like to mention is probably the Vietnam, even though I'm Vietnamese, but we have been in contact with a certain entity in Vietnam as well. So we would consider them as a Google of Vietnam, even though the regulatory situation there still be unclear, but yeah, there's a strong push for the development for the large institution in that country as well. And yeah, that's probably applicable to maybe here in Indonesia and of course Singapore as a institution use cases leader.
Okay, thank you for the insights. I'd like to move on to Ramzee from BitGo. So I'd like to ask you, how are the institutional custody practices, the evolution of it, how is it shaping, digital asset adoption globally, and what are the best practices that are emerging for APAC?
Oh, okay, thank you, Jordan, for your question. So to understand the whole situation, we have to respect the nature of blockchain technology first, I think. Because the beauty of blockchain technology is it's instant and irreversible, you know. And when you do a broadcast transaction in blockchain and it gets validated, there's no way you can undone the transaction. There's no undo button like we have in traditional finance. So I think we see a massive perspective change from we used to glorify self-custody and everything. In fact, I bring my ledger right here. We used to, as a personal investor, we glorify self-custody, right? And after a couple of years right now, you see crypto kidnapping is real. People get kidnapped and tortured for days to extort their assets because they do self-custody. And this kind of risk is not a risk that for institutional like BlackRock, Grayscale, Vanguard, they're willing to take. So obviously for institutional adoptions, we have to have a qualified custody. So like for instance, BitGo is one of a trust company who obligated by the law to segregate the client asset and protect their assets. And I think there's a major misconception in the discussion about custody as well, that a tech provider or wallet solution is not equivalent to qualified custodian. Because if you buy a wallet solution or technology, the private keys is still managed by your own ops people, right? And there's a big chance, and I'm sure everybody's here aware that every day someone from Lincoln trying to offer you a job, this opportunity and that opportunity. There's a big risk of phishing, right? And if that's happened, just one wrong click, the malware get distributed to your system, and you're done. And we can see that earlier this year, Bybit get hacked for 1.5 billion US dollar worth of ETH because of, for some reason they successfully alter the interface of the transaction and they sign it anyway. So I think managing and private key management is essential, and how to distinguish whether the tech provider is not a qualified custodian is very important for institutional to be aware of.
Thank you. Yeah, I mean, you guys at BitGo obviously are, one of the top choices. You work with a lot of very respected institutions. So also perhaps like to ask as well regarding what are some of the standards that are required by them, in terms of like security, compliance, that kind of stuff.
Sure. So as I mentioned earlier, asset segregation is one of the most important things you can consider when you select a custodian, because you have to understand that the asset of clients doesn't have to be mingled by the institution assets. And second, pretty much standard like SOC, it's a series of audit reports issued by independent auditors that basically verifying that, for instance, SOC 1 is for the number is tally, the number is there, the money is there, your vault is safe, and SOC 2 mainly was whether the sufficient internal control been applied to the company, and other thing is bankruptcy remoteness. So for instance, BitGo as a charter trust, tomorrow we go insolvent or bankrupt, knock on wood, our clients' assets are safe because it's segregated by the law, and we have to make our clients whole because of our status as a charter trust.
So how would you see demand changing for stuff like qualified custody, MPC wallet technologies, or I think recently as well, there has been a lot of like talk about institutional staking. So how would that change the landscape in your opinion?
Yeah, I mean, speaking of staking, for us, retail investor, personal investor, staking is just clicking one button and done. We're just looking for a highest yield we can find in the DeFi or any exchanges. But for institutions, it's a lot more complicated than that. They're aware there's a slashing risk. They're aware they must be aware, and they're responsible to their stakeholders and their clients to understand what the process really looks like, where they send the asset to. So we at BitGo, we work with top of validator in the market to make sure all the process is safe, and we built a technology where we built the staking that happen when the asset is still on our qualified regulated storage to protect the clients from slashing risk.
Okay, thank you. I'd like to hop back to Fandy for a bit. I guess we'd like to know as well where these institutions are, entering the digital asset space. What are some of the considerations, especially when it comes to governance, security, regulations, stuff like that?
Sorry, can you repeat that? Is about the...
Yeah, so what matters more for institutions when they're
Got it.
entering digital assets?
Got it. Well, I don't know what matters most to most institutions, but what matters most to us when, as mentioned earlier, we're looking at a few digital asset treasury companies. And what matters most is where they are obviously holding their digital assets, right? Which geography, and does the regulation support it? And this is coming from a Web2 perspective as well. If that particular digital asset is in that particular jurisdiction, how is it being taxed? Because obviously we have a responsibility to our LPs. And also, who are the clients this particular custody is serving in that particular geography? And I guess like Irsan mentioned just now, if it's segregated, what happens if the company disappears tomorrow? Will we still have our assets? Because obviously at the end of the day, we are responsible for our investors' money.
Right. So how would you approach due diligence when it comes to all these various partners, right? Like custody, asset protocol, service providers. What's your approach to due diligence?
I guess I'll repeat a bit what I said earlier. I guess I will look at who they're serving in terms of clients, and I'll see if they're segregated in terms of where our asset is compared to other people's assets. And I guess regulatory, right? Geography is the most important. I don't want my asset to suddenly be sent somewhere.
Right. So what do you think right now is missing in Asia's infrastructure in terms of allowing us to fully support large-scale institutional participation?
I think regulation. I think government support, government and just encouragement to, and then of course education. I think those are the ones that's missing. Again, I think in the US is leading the way now, and I hope Southeast Asia catches up eventually.
Right. Okay. So I'd like to move on to Minesh as well. When it comes to institutional adoption, I guess transparency, pricing efficiency, operational safety, those are all key concerns for institutional clients, right? So, you're a market maker, you should know very well. Could you share a bit more on how you guys actually enhance all these, requirements, like in terms of transparency, pricing efficiency? How do you make it better for all these clients?
Yeah, to be honest, there are a lot of different factors that go into managing risk. I guess if I had to shortlist a few of them, and definitely the main risk factors that we look at, liquidity risk is definitely a big one. I mean, we can go back to what happened October 11th. If you wanted to buy or sell a position today, right, given the liquidity in the market, it doesn't mean you'd be able to do it next week. And on October 11th, we saw a lot of the liquidity be pulled from the market. A lot of market makers stepped out, a lot of retail traders. So liquidity risk is definitely important. I would say counterparty risk also is up there purely because, I mean, look, I'm sure a lot of people in this room are familiar with Free Arrows Capital and FTX and what happened. You deposit funds on your exchange and you wake up the next day and they're not yours. I guess it goes back to the old adage, if it's not your keys, it's not your funds. And I think actually quite recently we saw a case with quite a prominent exchange where a user deposited some of 7 figures or whatnot, and they tried to withdraw it, and the exchange halted their ability to do so. Eventually, they ended up, doing a public outcry on X to retrieve the funds, and it ended up working. But it's very clear that the fact that they got their funds released was down to the discretion of the exchange. So it can be quite scary when you deposit figures so large and you're unable to withdraw it and move it as freely as you wish. And then I guess lastly, up the list would be execution risk. Execution risk really entails how quick your systems are. Do you have slow systems? Are you manually entering and exiting positions? I guess for the most part, if you're a retail user and you wanted to buy 0.01 Bitcoin, right? you don't really care what price you're getting in the market. You want to buy your Bitcoin and put it in cold storage, great. But if you're an institution trading in large size, or you're a market maker trading in large volume, the final price you get is very, very important because it directly eats into your bottom line, right? I guess this is what prevents a lot of market makers being profitable, is because they don't really take into account a lot of the time the execution risk.
Okay, got it. Thank you. So I guess maybe I'd like to hear from Kanet as well, from the bank's perspective. What kind of regulatory and compliance challenges have to be resolved before tokenized money systems can be adopted at scale?
Yeah, I think.
Yeah, I think market makers can definitely come in and enhance transparency and safety in the markets. I guess the low-hanging fruit would be things like providing better spreads or better liquidity on the books, or maybe inventory management frameworks to better help institutions understand how their assets are behaving. Yeah, yeah.
Okay.
Actually, on top of that, I would also add this idea of data transparency. I think there is a huge lack of transparency in the market. So because everything is done via API and exchange connections, really market makers can provide facilities where you can give a real-time order flow or volatility metrics, or really anything around the ability to manage these assets. And I feel like today there is a large stick around trading in general because there's a huge lack of transparency, whereby in more traditional markets, there are certain regulations in place that enforce a level of transparency that has to be followed. But in crypto, I think because we're still quite nascent, but we're yet to improve on some of these areas.
Okay, got it. Perhaps Kanet, do you have anything to share from your perspective?
Yeah, so if it was to be something that I can add, it would be like the most fundamental thing is the definition chaos is still true, right? Because if something can be considered as a stable coin in Indonesia, it's probably considered as something else in Thailand and in the other country as well. And the different definition that each country has, that leads to the boundary, right? Because blockchain, there's no boundary in blockchain, but with different definition, it's result in that a certain use case that create in a certain country can go abroad or can incorporate in other country. I think that is still true. And the other one is would be like the trust that we need to build to the regulator, right? If we were to look from the regulator perspective, I think that they had a job in order to ensure the public safety of the entire financial system. But I think the way I would like to encourage us to approach this, let's not take it as a problem. Let's take it as a challenge, right? If we were to see like currently there's some measure, there's some regulation that the regulator have, right? Please don't take it like as an end of the world or an end result that okay, the regulator don't allow us to do this. Okay, we can not operate in this market or in this solution. The question is, the next step is to ask ourselves, so what caused the concern? What really caused the concern to the regulator in order for them to execute or to have such measure, right? And if we were to be able to address their true concern, I think it's all the definition can change, all the challenge can be overcome.
I see. So, you guys have been very involved in a lot of the early institutional pilots in Thailand and the region. So what lessons could, any takeaways from all these early pilots?
I think the best creator is not the fastest creator, but the best collaborator. Because at the very center of the blockchain, right, the blockchain is just a solution to solve human collaboration problem. So it's applicable to the blockchain / financial institution use case creation as well. So let's think about it this way. In Thailand, there's been a number of pilot, there's a number of collaboration. Launching a press release is easy, right? But ensure that, okay, this solution can, after graduation, they can really get into production is another story. But what separates those who just live in the pilot, but what get into the production is whether they're on board the regulator since their early stage, right? So for example, if you want to develop blockchain/AI solution. And instead of, okay, just waiting for the GPT 6.0 to release and everything to be perfect and all the regulation clarity to happen, I would suggest you would like to kind of talk to the regulator since the early stage and kind of let them to be part of your journey. Okay, this is what we are thinking that should happen. This is all the challenge that we are dealing with. And yeah, let's treat them as a partner, not kind of adversary. I think that's probably like the key takeaway to guarantee the success of the financial institution-led blockchain project.
Okay, thank you. Yeah. Next question I'd like to ask Irsan is, as more institutions across Asia, across the world, they start, becoming interested in digital assets, how do you ensure, as a custodian, how do you ensure compliance across multiple jurisdictions while still ensuring your operational efficiency?
Yeah, probably as Kenneth just said it just now, it's very nicely that blockchain is borderless, but the underlying asset is not. So we have to not only build a blockchain, but build an effective bridge to bridge the traditional assets who, from multiple jurisdictions, has their own rules to, to mimic the movement with the assets in the blockchain, right? So in BitGo, we commit a lot of and work with a lot of regulator around across the globe. In the US, we obviously one of the trust chapter in New York and South Dakota. And in Europe, we work closely with Mika, with Buffin in Germany as well, to understand how to issue stable coins there, what's the digital asset service provider requirements looks like. And in Asia, in APAC here, we working closely with MAS as well, and we have MPI license that make sure that BitGo understands how to bridge the asset from traditional finance to tokenize the digital assets.
Right. So I guess a similar question to what I asked some of the earlier panelists as well. What kind of infrastructure do you think is needed to support, institutional staking, tokenization, custody, treasury grade kind of like asset management? Yeah.
As probably everybody just answered very beautifully earlier that it's not an easy job because tokenized asset is just a piece of code, right? It's inside a blockchain. It can be, if you have time and you build the tokenized asset, it can be done. But the trickiest part is with how to work with the regulator, how to establish a robust framework that would work for all industry player and all regulator that put safety of all the stakeholders in mind and grow the industry sustainably in the future.
Okay. So I guess this will be the last question from me. I think it's more of a open-ended to all the panelists. So just like to talk about the future outlook of the industry, what you think institutional digital asset, the landscape will be looking like in the next 3 to 5 years, what you think would be the key enablers of this, as well as the role of regional hubs in terms of shaping digital asset adoption. So I'd perhaps like to go down and ask each of you to share your thoughts on this. Fandy?
Yeah, I guess in the future, I think a lot more adoption, of course, and I think a lot more transactions. I think a lot more use cases on our day-to-day lives with stable coins, things like that. And I think what needs to happen for that to materialize is, of course, regulation, but of course, more investments into the space and more widespread education, right? On how helpful it is to have to be living day to day with this technology. So, yeah, I think the future is very bright and it lives on chain.
Okay, thank you. Minesh?
Yeah, I would say Asia is definitely very well positioned to lead this wave. We're seeing a lot of bank-backed infrastructure and regulatory clarity emerging across places like Singapore, Thailand, Indonesia. Furthermore, we're seeing a lot of really big collaborations between exchanges, financial institutions, and tech providers. So I think Asia is going to be doing very well in this sector. And look, if we look at digital assets as a whole, it's a very nascent market. And if we look at Southeast Asia, it's an emerging market. So you have a nascent market in an emerging market, and if that doesn't scream opportunity, I don't know what does. And so I'm personally hedging my bets here. And I mean, look at this exhibition, right? Look at Indonesia Blockchain Week or any blockchain, or any conference for that matter. You have builders coming from all walks of life, you know, all the capital cities, all the countries around the world with one thing in mind, which is to network, build, and collaborate. So I definitely think Asia is positioned very well to kind of lead this wave. Yeah.
Okay, Kanet?
Thank you. I believe the distinction between blockchain and traditional finance, it will get kind of gradually destroyed in the future. I'm guessing in the future, there will be no distinction between digital asset and asset because all the asset will become digital. And also, yeah, the intersection between blockchain/AI is worth keeping an eye on as well. For now, there's kind of a distinction, right, between when we are using traditional finance and when we are using the blockchain, we still need to deal with wallet and all the UX complexity. I think it would get like solved soon in the future. And in order for this to happen, I think I'm very bullish on the work of all developers. I think even though for now it has been led by regulator, it has been led by all the institutions, but I think the real power is from the developer. That how can we get enough support from institutions because they are completely open and want to help push this space forward.
For me, not much different from my friends right here, because Asia is always seen as a retail-driven kind of market, right? And I think it's about to come. The institutional part will be joining the party shortly with us in next 2026. And for instance, in Indonesia right here, last year, crypto is still considered or classified as a commodity under regulation of Bapepti. And early this year, it's reclassified as a digital asset under OJK, which is a massive, massive win for us in crypto industry, that validating our existence. And it's just about time that crypto and financial assets are interwoven in the whole financial structure.
Okay, yeah, I thank all the panelists for the insights. I think regardless, the institutions are going to play a very pivotal role in defining the future. Like, it would be great if there would be no distinction in the future, right, between digital assets and normal assets. Everything would be treated the same. Yeah, I guess, the key takeaways would be that we would still need to be strengthening custody frameworks, building infrastructure together. And it's really key that, all these tech providers, the regulators, these various financial institutions all work together to to help build the necessary pieces to work towards that future. So yeah, thank you guys for all the various insights, and I would be passing the time back to the MC.
Chic. All right, thank you, Jordan, and all speakers for such a comprehensive insight about the institutional evolution of digital assets. Thank you so much. And can we have a quick group photo together on the stage before you leave the stage? All right, thank you so much. Once again, thank you, Fandy from Kopital. Thank you, Minesh from System 9, Kanet from Quarix, and also Irsan for BitGo for having your moment and joining us for Indonesia Blockchain Week 2025. Once again, friends, ladies and gentlemen, can we have a big round of applause for our panel number 2 this very early afternoon. Thank you, Jordan. Thank you, gentlemen.